In January of 2000, I sat down to write what would become the most important memo of my career. I didn't know it at the time. I thought I was just putting observations on paper, the same thing I've been doing for years. But that memo titled Bubble.com, changed everything. It changed how people thought about me. It changed how I thought about markets. And most importantly, it captured something that very few people were willing to say at the time, that the greatest bull market in history was about to end in disaster. Let me take you back to that moment, because understanding the context is essential to understanding why the memo mattered. By early 2000, the stock market had been rising for 18 consecutive years. An entire generation of investors had never experienced a real bear market. People who started investing in 1982 had seen nothing but gains, interrupted only by brief corrections that were quickly recovered. The crash of 1987, when the market fell 22% in a single day, had been forgotten. It was ancient history, a blip that recovered within 2 years. The lesson people drew from that crash was not that markets could be dangerous, but that you should always buy the dip because stocks always came back. The technology sector had gone parabolic. Companies with no earnings, no business models, and sometimes no revenue were valued at billions of dollars. The Nasdaq had risen from around 1,000 in 1995 to over 5,000 by March of 2000. That is a 500% gain in 5 years. 500%. To put that in perspective, the long-term average return on stocks is about 10% per year. The Nasdaq had delivered 50 years of average returns in 5 years. Anyone who stopped to think about this mathematically should have been alarmed. Returns had been borrowed from the future. Eventually, they would have to be paid back, but nobody wanted to stop and think. The momentum was too strong. The gains were too intoxicating. The social proof was too overwhelming. I remember conversations from that period that seem almost surreal in hindsight. People genuinely believed that traditional valuation metrics no longer applied. Price-to-earnings ratios were dismissed as old thinking. What mattered was price to clicks, price to eyeballs, price to revenue growth. The phrase, new economy, was everywhere. The old rules, we were told, had been repealed. And the mood was euphoric. Everyone was making money. Your neighbor was getting rich day trading. Your taxi driver was giving you stock tips. CNBC was appointment television. Investment bankers were celebrities. The fever had infected everyone. This was the environment in which I sat down to write Bubble.com. The memo opened with a simple observation. The current market environment was displaying all the characteristics of a speculative bubble. Not some of them, all of them. Prices disconnected from fundamentals. New paradigm thinking used to justify absurd valuations, widespread public participation, turning investing into a national pastime, dismissal of skeptics as dinosaurs who didn't understand the new world. I wrote about the psychology of bubbles, how they begin with a kernel of truth. The internet was real. It would transform business. Some internet companies would become enormously valuable. But the leap from the internet is transformative to any company with a website is worth billions, was unjustified and dangerous. I wrote about the mathematics of valuation for many technology stocks to justify their prices. They would need to grow at rates that were mathematically impossible, not unlikely impossible. The market for their products simply wasn't large enough to support the implied growth. I wrote about the historical precedents. Every previous bubble in history, from tulip mania to the South Sea bubble to the 1920s stock boom, had ended in collapse. Every single one, the pattern was remarkably consistent. Prices rise, skeptics are dismissed, new era thinking takes hold, and then reality reasserts itself violently. I studied these bubbles carefully before writing the memo. What struck me was not just that they all ended badly, but that they all followed the same psychological pattern. In every case, intelligent people convinced themselves that this time was different. They had reasons. The reasons were always plausible, and they were always wrong. Tulip mania in 17th century Holland was justified by the genuine beauty and scarcity of certain tulip varieties. The South Sea bubble was justified by supposedly unlimited trade opportunities with South America. The 1920s bubble was justified by technological innovations like automobiles, radio, and electricity that were genuinely transforming the economy. The internet was the 1999 equivalent, and like those earlier innovations, it was real. But the fact that an innovation is real doesn't justify any price for companies associated with it. And I wrote about what I thought would happen next. I predicted that when the bubble burst, and I was confident it would burst. The losses would be staggering. Companies that were worth billions would be worth nothing. Fortunes that existed on paper would evaporate. The psychological damage to a generation of investors would be profound. I also predicted something that many people dismissed, that the crash wouldn't be limited to technology stocks. Bubbles, once they burst, tend to spread. The leverage, the interconnections, the confidence, all of it unwinds. I expected the broader market to suffer significant losses and the economy to weaken as the wealth effect reversed. The response to the memo was fascinating and instructive. Some people appreciated it. They told me I was articulating something they felt but couldn't express. The memo gave voice to their unease. These were often older investors, people who had lived through previous cycles and recognized the pattern, even if they couldn't quite name it. I received letters from people who said they had been feeling crazy, like something was wrong, but everyone around them was so confident that they doubted their own judgment. The memo validated their instincts. It gave them permission to trust what they were seeing, but many people dismissed it entirely. I was called a dinosaur. I was told I didn't understand technology. I was told I would miss the greatest wealth creation opportunity in history by sitting on the sidelines. Some of the dismissals were polite. People would acknowledge that I had a point, but argue that the excesses were limited to a small number of speculative stocks while the broader market was fine. They were wrong. The contagion was everywhere. Author dismissals were hostile. I was accused of talking down the market for my own benefit, of being jealous of technology investors who were getting rich while I sat on the sidelines, of being too old to understand the new world being born. These attacks were personal and unpleasant. I remember one meeting particularly vividly. I was presenting to a group of potential investors, sophisticated people who manage substantial assets. When I expressed my concerns about technology valuations, one of them interrupted me. "Howard," he said, "you just don't get it. The internet changes everything. The old rules don't apply anymore." I asked him a simple question: what multiple of revenue are you willing to pay for a company with no profits and no clear path to profitability? He looked at me like I was speaking a foreign language. The question itself, he seemed to think, revealed that I was hopelessly out of touch. He couldn't even engage with it. The frame of analysis that asked about price relative to fundamentals had become so foreign that it was literally incomprehensible to him. That moment has stayed with me for 25 years. Not because he was a fool. He was smart and successful, but he had been captured by a narrative so powerful that it shut down critical thinking. He couldn't even hear a question about valuation because the question itself belonged to an old paradigm he had rejected. 2 months later, the Nasdaq peaked. Over the next 2.5 years, it fell almost 80%. Trillions of dollars in wealth evaporated. Companies that had been valued at hundreds of billions simply ceased to exist. The dot-com crash destroyed more paper wealth than any event in history up to that point. The people who had called me a dinosaur stopped calling. Some of them apologized. Many of them had lost fortunes. A few had lost careers. This experience taught me something I've carried with me ever since. Being right is not enough. You have to be right, and be willing to say so when everyone disagrees with you. In early 2000, the consensus was overwhelming. The new economy was real. Valuations were justified. Skeptics were wrong. Saying otherwise required going against every social pressure you can imagine. Your friends thought you were foolish. Your competitors were making money. You weren't. Your clients questioned whether you understood the world you were investing in. Most people, even if they privately harbored doubts, went along with the consensus. They told themselves maybe this time was different. They told themselves they'd get out before the crash. They told themselves the skeptics had been wrong before and would be wrong again. I wrote the memo because I couldn't not write it. The evidence was so overwhelming, the bubble so obvious, that staying silent would have been a form of cowardice. My job was to protect my investors' capital. How could I do that while pretending not to see what was directly in front of me? But let me be clear about something. Writing that memo was not easy. It felt deeply uncomfortable. There was real professional risk involved. If the bubble had continued for another few years, which it could have, I would have looked foolish and my firm might have suffered. This is the reality of contrarian thinking. It is not enough to be right. Eventually, you have to survive the period when you are wrong or appear to be wrong before you are right. Many investors with correct views have been destroyed because they expressed those views too early or too aggressively. The memo worked out for me because the timing happened to be close to perfect. But I want to be honest, I didn't know when the bubble would burst. I just knew that it would. If it had continued for another 2 or 3 years, my career might have taken a different path. Let me tell you what I learned from this experience, because these lessons have shaped everything I've done since. The first lesson is that extreme valuations always matter eventually. During the bubble, people convinced themselves that valuation was irrelevant. What mattered was growth, optionality, market opportunity. Traditional metrics like price to earnings were dismissed as outdated. This was wrong. Valuation always matters. It determines your future returns. When you pay an extreme price, your returns will be poor, even if the company executes perfectly. When you pay a reasonable price, your returns will be good, even if the company merely performs adequately. The dot-com crash proved this conclusively. Many internet companies actually did become important businesses. Amazon survived and thrived. So did eBay and others. But investors who bought these stocks at bubble valuations still lost money for years, because the prices were so inflated that even excellent business performance couldn't justify them. Consider Amazon specifically. The company has become one of the most valuable in the world. It revolutionized retail, built a dominant cloud computing business, and generated extraordinary shareholder value over 2 decades. By any measure, Amazon was one of the great business success stories of our time. But if you bought Amazon at its peak in late 1999, you lost more than 90% of your investment over the next 2 years. Even though the company survived and eventually thrived, it took until 2009, nearly a decade, for Amazon stock to return to its bubble-era high. This is the reality of valuation that people forget when they're caught up in narratives. A great company is not necessarily a great investment. A transformative technology does not guarantee profits for investors. Price matters. What you pay determines what you earn. I've carried this lesson forward. When I see extreme valuations, I become cautious, regardless of how compelling the story seems. Stories can be true, and stocks can still be overpriced. The internet changed the world. Investors who bought at bubble prices still lost fortunes. The second lesson is that the crowd is often wrong at extremes. Humans are social creatures. We take comfort in agreement. When everyone around us believes something, we're inclined to believe it too. This is adaptive in many contexts, but deadly in investing. At market extremes, the crowd is almost definitionally wrong. At peaks, everyone is bullish, because if they weren't, prices wouldn't have reached those levels. At bottoms, everyone is bearish for the same reason. Following the crowd at these moments guarantees poor results. The memo worked because it went against the crowd. That was its value. Anyone can identify a bubble in hindsight. The skill is identifying it in real time when everyone is telling you you are wrong. Since 2000, I've tried to cultivate the willingness to disagree with consensus when the evidence warrants it. This is uncomfortable. It often makes you unpopular, but it is essential for avoiding the worst mistakes. The third lesson is that psychology drives markets in the short term, but fundamentals drive markets in the long term. During the bubble, psychology was in complete control. Prices rose because people expected them to rise. Stories justified any valuation. Fundamentals were ignored. But fundamentals always reassert themselves eventually. A company with no profits cannot sustain a billion-dollar valuation indefinitely. A stock trading at 1,000 times revenue cannot keep rising forever. Reality has a way of intruding on fantasy. Understanding this dynamic helps you be patient when markets are irrational. You don't have to predict exactly when psychology will give way to fundamentals. You just have to know that it will and position accordingly. The fourth lesson is that surviving matters more than maximizing. During the bubble, we could have invested aggressively in technology stocks and probably made money for a while. Many firms did exactly that. They generated tremendous returns in 1998 and 1999 by riding the wave. But many of those firms suffered catastrophic losses when the bubble burst. Some went out of business entirely. The gains they captured on the way up were more than offset by the losses on the way down. We survived because we prioritized not losing money over maximizing gains. We looked foolish for a while, underperforming dramatically during the blow-off phase of the bubble. But we were there to deploy capital when the crash came, when opportunities were extraordinary and competitors were licking their wounds. This is a lesson I've never forgotten. Investment success is not about having the best year. It is about compounding over decades, and compounding requires survival. Taking excessive risk for short-term gains is a losing strategy because eventually the risk materializes and destroys you. Let me illustrate this with mathematics. Suppose two investors each start with $1 million. Investor A takes high risk and earns 30% returns for 3 years, then loses 60% in year 4. Investor B takes moderate risk and earns 15% every year. After 4 years, Investor A has 1 million times 1.3 times 1.3 times 1.3 times 0.4. That equals about $880,000. Investor B has 1 million times 1.15 to the fourth power. That equals about $1.75 million. Investor B, with lower returns every year, ends up with twice as much money because they avoided the catastrophic loss. This is the mathematics of loss avoidance. Large losses are devastating to compound returns because you need even larger gains to recover. A 50% loss requires a 100% gain to break even. A 60% loss requires a 150% gain. A 75% loss requires a 300% gain. The deeper the hole, the harder to climb out. This is why I've always prioritized not losing money over making money. The investors who took aggressive technology positions in 1999 had great returns for a while. But the losses they suffered in 2000, 2001, and 2002 wiped out those gains and more. Many of them never recovered financially or psychologically. We survived because we were willing to look foolish in the short term. We accepted underperformance during the bubble in exchange for avoiding the crash. That trade has always been worth it. The fifth lesson is that writing forces clarity. I've been writing memos since 1990, but Bubble.com showed me just how powerful writing can be as a tool for thinking. When you write, you force yourself to organize your thoughts. Fuzzy intuitions become concrete arguments. Gaps in logic become apparent. Half-formed ideas get completed or discarded. You discover what you actually believe as opposed to what you vaguely think. The process of writing that memo clarified my own thinking. I started with a general sense of unease about the market. The valuation seemed crazy. The psychology seemed fevered, but I couldn't quite articulate why it all added up to something dangerous rather than just expensive. By the time I finished writing, I had a fully developed framework for understanding what was happening and what would happen next. The act of putting words on paper forced me to connect the dots, to reason from evidence to conclusions, to test my logic against itself. Writing also forces honesty. When you speak, you can be vague, you can hedge, you can imply things without committing to them. Writing pins you down. The words are there on the page, clear and specific. You can't pretend you meant something different. This forces intellectual courage. When I wrote Bubble.com, I had to actually say that we were in a bubble, not suggest it, not hint at it, say it. And once you've said something clearly, you are accountable for it. If you are wrong, everyone knows. That accountability forces you to think harder before you write. Since then, I've written memos constantly, not just to communicate with investors, but to clarify my own understanding of markets. The discipline of putting thoughts on paper has been invaluable. Every memo I write, I learn something. Sometimes I discover I don't believe what I thought I believed. Sometimes I discover logical flaws that require me to change my view. The process is illuminating in ways that pure thinking never is. I encourage everyone, investor or not, to write regularly. Keep a journal, write letters. Draft essays, even if you never publish them. The discipline of articulating thoughts in words will sharpen your thinking more than almost anything else. Let me also share what I got wrong, because intellectual honesty requires acknowledging mistakes. The timing of the memo was close to the peak, but that was partly luck. I had been concerned about valuations for at least 2 years before I wrote it. If I had written Bubble.com in 1998, I would have looked foolish for 2 years before being vindicated. Markets can stay irrational longer than you can stay solvent, as the saying goes. I also underestimated how long the aftermath would last. I thought the crash would be sharp, but relatively brief, followed by a recovery. Instead, the Nasdaq didn't return to its 2000 highs until 2015. 15 years later, the damage was far more lasting than I anticipated, and I didn't foresee all the second-order effects. The dot-com crash contributed to a recession, which contributed to the Federal Reserve cutting interest rates, which contributed to the housing bubble, which led to the 2008 financial crisis. These chains of causation are obvious in hindsight, but nearly impossible to predict in advance. These mistakes taught me humility. Being right about the big picture doesn't mean you'll be right about all the details. You can correctly identify a bubble, without correctly predicting its exact timing or consequences. The future is fundamentally uncertain, and even correct analysis yields only probabilistic conclusions. Now, let me bring this forward to today, because I think the lessons of bubble.com are relevant right now. I am not saying we're in an identical situation. Every market environment is unique. The specific excesses of 1999, the day trading mania, the pets.com absurdity, the total abandonment of valuation discipline haven't been fully replicated. But some parallels concern me. Valuations in certain parts of the market are extreme by historical standards. The Shiller cyclically adjusted price to earnings ratio is above 30, roughly double its long-term average. The market capitalization of U.S. stocks relative to GDP is at or near all-time highs. Price-to-sales ratios for popular growth stocks are at levels that have historically preceded poor returns. The concentration in a handful of mega-cap technology stocks is unprecedented. The largest companies in the market now represent an enormous share of total market capitalization. When you buy an index fund, you are not really buying diversified exposure to the U.S. economy. You are making a concentrated bet on a few dominant players. This concentration creates hidden risk. If these companies stumble, if their growth slows, if their valuations compress, the impact on the broad market will be enormous. Index fund investors who think they're diversified may discover they're not. Psychology has elements of excess. There is a widespread belief that certain companies, particularly in technology and artificial intelligence, will grow to dominate the global economy. This may be true, but the certainty with which it is expressed, and the prices being paid for that expected dominance, remind me of earlier periods of overconfidence. I hear echoes of 2000 when people discuss artificial intelligence today. The technology is real. It will be transformative. Some companies will benefit enormously. All of that is true. But the leap from I is transformative to any company exposed to AI deserves a premium valuation is the same logical error that was made about the internet. New paradigm thinking is present. I hear arguments that traditional valuation metrics don't apply to platform businesses, to companies with network effects, to AI beneficiaries. Maybe these arguments are correct. But I've heard similar arguments before, and they've usually preceded disappointment. Every bubble comes with sophisticated-sounding justifications for why traditional analysis doesn't apply. In the late 1920s, it was the new era of permanent prosperity. In the late 1990s, it was the new economy of limitless growth. Today, it is the platform economy, or network effects, or artificial intelligence. The specific justification changes. The pattern doesn't. Skeptics are dismissed. When I express caution about valuations, I am sometimes told I don't understand the new economy, that things are different this time, that traditional thinking is outdated. This is the same response I received in 2000. It doesn't prove I am right, but it is a warning sign. The dismissal of skeptics is itself a warning sign because it indicates a market that has stopped questioning itself. Healthy markets include debate. Bubble markets suppress it. When everyone agrees and dissenters are marginalized, that unanimity often precedes reversals. I want to be clear, I am not predicting an imminent crash. I don't know when or if current valuations will correct. Markets can stay elevated for a long time, and specific catalysts for declines are nearly impossible to predict. What I am saying is that the risk-reward has become less attractive. When valuations are high and psychology is elevated, future returns tend to be lower, and the risk of significant declines is higher. This doesn't mean you should sell everything and hide in cash, but it does mean you should be thoughtful about risk, realistic about return expectations, and prepared for volatility. The bubble.com memo wasn't valuable because it predicted a crash on a specific date. It was valuable because it correctly assessed the environment as one of elevated risk. It helped investors position defensively before the storm hit. That is what I try to do in every memo I write. Not predict the future, because that is impossible, but assess the present environment as accurately as possible, identify the risks and opportunities, and help investors position appropriately. Let me share one more thought about the memo and what it meant for my career. After the dot-com crash, the memo became widely read. It established a reputation for independent thinking and willingness to go against the crowd. That reputation attracted investors who valued those qualities. Our assets under management grew significantly. But the memo's success also created expectations that have been hard to live up to. People expect me to call every market turn. They treat every cautionary memo as a prediction of imminent disaster. When I express concerns and markets continue rising, they ask whether I've lost my touch. This pressure to repeat past successes is dangerous. It can push you toward making dramatic predictions to maintain relevance. It can make you overconfident in your ability to time markets. It can lead to crying wolf so often that nobody listens when the wolf actually arrives. I've tried to resist these pressures by being clear about what I do and don't know. I can assess whether markets are expensive or cheap. I can identify when psychology has become extreme. I can describe the risk-return proposition at any given moment. What I cannot do is predict exactly when markets will turn or how far they'll move. This humility is essential. Bubble.com worked partly because of luck and timing. The analysis was sound. But I could have written the same memo a year earlier and looked foolish for a while. Acknowledging the role of luck keeps you grounded and prevents overconfidence. The memo also taught me about the responsibility that comes with influence. When Bubble.com became widely read, my words started affecting how people invested. That is a heavy responsibility. If I am wrong, people lose money following my advice. This responsibility has made me more careful. I try to present my views as assessments of probability rather than certainties. I try to acknowledge what I don't know alongside what I think I do know. I try to help people think rather than tell them what to do. Looking back over 25 years since Bubble.com, I am proud of that memo. Not because it predicted a crash, though it did, but because it demonstrated values I've tried to uphold throughout my career. Intellectual honesty, willingness to be unpopular, focus on risk control, and commitment to clear thinking. Those values have served me well. They've helped me avoid the worst mistakes, even when I haven't captured the best opportunities. They've attracted investors who share those values. They've made my career meaningful beyond just generating returns. If there is one thing I hope you take from this story, it is that independent thinking matters. The world is full of pressure to conform, to follow the crowd, to accept consensus views. Resisting that pressure is hard. It is lonely. It often makes you wrong. But at the moments that matter most, at the extremes, when fortunes are made and lost, independent thinking is essential. Crowds are wrong at extremes. Following them leads to disaster. The only protection is the willingness to think for yourself, assess evidence objectively, and reach conclusions regardless of their popularity. That is what Bubble.com represented. Not genius, not prophetic ability, just the willingness to say what I believed even when everyone disagreed. That willingness changed my career, and I believe it can change yours too, if you have the courage to cultivate it. The market will present opportunities to demonstrate that courage. It always does. There will be moments when the crowd is clearly wrong, when the evidence points in one direction and consensus points in another. At those moments, you'll face a choice. Go along with the crowd and avoid discomfort, or trust your analysis and accept the social cost. I hope when that moment comes, you'll have the courage to write your own Bubble.com. To put your views on paper, to say what you believe, even when it is unpopular. That courage, more than any analytical technique, is what distinguishes successful investors from unsuccessful ones. It is what the memo taught me, and it is what I've tried to practice every day since. That memo changed everything. Not because I predicted a crash, but because it showed me what kind of investor I wanted to be. An honest one, a thoughtful one. One willing to be wrong in the short term, to be right in the long term. One who prioritizes not losing money over making money. 25 years later, I am still trying to be that investor. Still writing memos, still trying to see clearly in environments of distortion, still willing to say unpopular things when I believe they're true. That is the legacy of Bubble.com. Not a single correct prediction, but a framework for thinking that has served me through multiple cycles, multiple crises, multiple periods of euphoria and despair. If that memo changed everything for me, perhaps sharing its story can help you develop your own framework, your own willingness to think independently, your own courage to go against the crowd when evidence warrants it. Because the next bubble is out there somewhere. The next moment when crowds are clearly wrong. The next opportunity to see what others don't see. When that moment comes, I hope you'll be ready. I hope you'll have the courage to act on your convictions. And I hope you'll remember that being right is not enough. You have to be right and be willing to say so. That is what Bubble.com taught me, and that is what changed everything.